Hey everyone, gold skyrocketed almost 64% in 2025. Crazy, right? But here's the big question. Could 2026 bring a crash like 1980 or 2011? In this video, we'll dive into the history, today's numbers, and what could realistically happen. Let's get into it. Motion visual cues. Hands open on crazy, right? Slight lean forward on big question. Visual. Gold bar plus 2025. Spike chart animation. Back in 1980, gold had surged through the 1970s because of high inflation, oil shocks, geopolitical stress, and collapsing confidence in the dollar. Then Paul Volcker raised interest rates toward 20%. Real yields went sharply positive, confidence returned, and gold dropped about 65%. Motion visual cues. Hands mimic rise and fall of gold prices. Eyebrows raise on 65%. Visual, gold chart. 1970-1980, upward and downward arrows. Fast forward to 2011. Gold peaked around 1,920 an ounce after the financial crisis. Quantitative easing was acting as insurance against inflation, but inflation stayed contained thanks to globalization, weak wage growth, and excess capacity. Real rates and the dollar later strengthened, risk assets recovered, and gold declined about 45% over several years instead of crashing immediately. Motion visual cues. Shrug shoulders on instead of crashing immediately. Hands slowly move downward to mimic price decline. Visual. 2011. Peak chart. QE iconography. Here's the main takeaway. Gold doesn't crash just because it's expensive or hits new highs. Gold crashes when confidence in fiat currency and monetary policy is restored. Think of gold as monetary insurance. When real interest rates are positive, the dollar is strong, and policymakers act disciplined. Cash and bonds can preserve value better than gold. Motion visual cues. Open palms for monetary insurance. Tilt head slightly on emphasis. Visual. Dollar versus gold. Side-by-side graphic. Rates are negative. Policy rates are around 3.75%. But true inflation, measured like in the 1980s, could be 6 to 7%. Savers are losing purchasing power instead of earning a real return. U.S. debt to GDP is over 120%, compared to about 30% in 1980. So 10 to 20% interest rates are politically and fiscally unrealistic. Central banks are buying gold at record levels, and countries are slowly de-dollarizing, creating baseline demand that wasn't there before. Motion visual cues. Count points on fingers. Lean forward on baseline demand. Visual. Negative real rate chart. Debt bar graph. Gold demand animation. Historical crashes require multiple conditions. Positive real yields, strong dollar, credible policy, shrinking central bank demand, willingness for economic pain. Current environment. None of these exist. Crash unlikely motion visuals. Checklist animation. Hands together gesture. Shake head. Unlikely. Sideways trading. Consolidation. Sharp 10, 15% corrections possible, but not 45, 60% crashes. Motion, JAG visuals. Sideways gold chart. Overlay text. 10, 15% correction. Hand gestures mimicking movement. Volcker-style policies, think 20% interest rates, are impossible now due to massive debt and fiscal limits. So structurally, gold has support. The usual triggers for a crash just aren't there. Motion visual cues. Stop, hand gesture on impossible. Lean back for calm emphasis. Visual. Political fiscal constraint icons. Structural support overlay. Gold's role today, it's insurance. It rises when cash loses value. It corrects, trades sideways, and occasionally dips sharply. Classic crashes? Only possible under extreme monetary discipline. Not likely in today's environment. Motion visual cues. Hands sweeping across screen point to charts when mentioning corrections. Visual. Gold versus cash comparison. Small correction graphs. Some key numbers to watch. U.S. fiscal deficit, $1.8 trillion. Debt to GDP over 120%. Central banks buying record gold. Inflation, Chucker 6.7%, true measure. Policy 3.75%. Real rates negative. Savers are losing purchasing power. But this supports gold structurally, instead of triggering a crash. Motion visual cues. Finger counting data points. Zoom in charts for emphasis. Visual. Animated infographics. So here's the final takeaway. A 1980 or 2011 style crash in 2026 is unlikely. Corrections and sideways periods are expected, but the long-term bull trend remains intact. Keep an eye on central bank moves, real rates, and fiscal policy. These are the real triggers. Thanks for watching, and stay tuned for more market insights.